So hello all my dearest students of South India. I hope you all are doing good. I hope your studies are going on great for your upcoming examination. So here I came up with one video which I promised to you all few days back, around 2-3 days back, that I'll be coming up. As you can see, compilation of non-resident taxation special rates. Now one of the biggest headache for a CA final students in direct tax is non-resident chapter. It is one of the trickiest chapter out of the entire syllabus of CA final. And in this chapter also, not the entire chapter is tricky. The trickiest part of this chapter are the special tax rates. 115A interest is covered, 115A dividend is covered, then 115A royalty and FTS is covered, 44DA is there, 115AB, 115AC, 115AD, then some NRI provisions. All of them are having different rates. All of them are having different payers, different pays. TDS sections are different. In some of the sections you get deductions, in some of the sections you don't get deductions, in some of the sections you don't get indexations when you sell the capital asset. So there are a lot of disparities in different sections. And because of that, when you read the first section, you remember the first section. When you read the second section, you remember the first and the second. When you read the third section, you remember the first, second, and the third one. When you read the fourth section, you remember the first, second, third, and fourth. But when you read the fifth one, you start to slightly fade out with the initial ones. The initial one slightly goes out of your mind. And when you reach till the 10th section, in all there are 10 special rate sections over here. So when you reach till the 10th section, everything is mixed it up. So what I have done it for you all is I have made a compilation of all the 10 sections. First of all, I'll tell you, and this compilation of 10 section will amount to around more than 50% of your NR chapter. Once you're done with this, then the rest of the part of NR is very simple. What is apart from this? Apart from this, what is there in NR is the residential status, which is very simple. Poem is also very simple discussion, nothing great as such. Section 9 deemed accrue, very simple. Presumptive income 44B, 44BB, BBA, BBA, all of them are very simple, nothing great as such. The most difficult part of this chapter is this particular 10 sections only. So how I have divided them into 10 sections, let me tell you. First of all, 115A has 4 types of interest. 115A interest 1, interest 2, interest 3, and then 115A interest 4. Then 115A has royalty and FTS without permanent establishment. And then 44DA royalty and FTS with permanent establishment. Then comes your 7th section 115AB, AC, AD, and the last one chapter 12A, which is for NRIs. So in all the 10 sections, there are various points that has to be kept in mind by the student. And this is impossible to remember. If you keep on reading one section independently, it is impossible to remember. It is the only way to remember this is through by reading the what? By reading them in a distinguished manner, in the form of a distinction between. So I'll tell you how to remember these sections here. I'll tell you exactly the approach of remembering this, and I will also explain you in a very short span of time, in around 20-25 minutes. I'll be dealing with all the 10 sections, don't worry. Now let me talk about the first one. In the first one, who is the assessee? The entity is non-resident and foreign company. What is non-resident and foreign company doing? They are giving loan in foreign currency. Very important. They are not giving loan in Indian currency. They are giving loan in foreign currency. To whom they are giving loan? They are giving loan to government or Indian concern. They are not giving loan to Indian companies. They are giving loan to Indian concerns and government. Then what is the tax rate? The tax rate in that case, the interest will be chargeable at 20% plus surcharge and cess is applicable. If applicable, cess is always applicable. Surcharge depends upon the income of the other person, and you will deduct the TDS. The payer will deduct the TDS under section 195. Okay, then are you going to get the deduction of PGBP against it? No deduction of PGBP. Are you going to get deduction of chapter 6A? No chapter 6A, only one chapter 6A allowed, that is ATLA. Apart from ATLA, no other chapter 6A will be allowed against the interest income covered in the first part. Then what about if you have some other business in India in which there is a loss? If there are some other business in India in which there is a loss, you can set off that loss against this income. There's no harm in that. What about other income? Other income will be charged at normal rates, and chapter 6A will also be allowed against the other incomes. Chapter 6A is not allowed against the special income. Only ATLA chapter 6A is allowed against the special income. What about the return of income? Is the non-resident supposed to file the return of income? If the non-resident fulfills 2 conditions, there is no need to file the return of income. First, if the non-resident earns only this interest income, and the TDS is also deducted at a rate mentioned in 115A, not lower than 115A. Suppose the rate mentioned over here is 20%, and if the TDS is deducted at 20%, and if the assessee only earns the interest income, there is no need to file ROI. But if the TDS is deducted, say at 15%, because in DT88 it is written 15%, because in DT88 it is written 10%, so it is lower than the rate mentioned in 115A. In that case, the assessee is liable to file the income tax return. This is a very important point which has been tested by ICI. So there are a lot of aspects that you have to see. who is the assessee, who is the payer, what is the instrument, what are the rates of tax, are we going to get the deduction, are we going to get chapter 6, are we going to get set off of loss, all these things has to be seen. So this is how you are going to read all the 10 sections. I'll read all of them, I'll discuss all of them, I'll explain all the important points out of all of them, all the nitty-gritties of all the 10 sections one by one. The second section is, in the second section also the assessee is non-resident and foreign company only, same. But here the person who is in India is an infrastructure debt fund. So non-resident foreign company is giving loan to infrastructure debt fund in any currency now. Now not in foreign currency. In first section it is foreign currency, in second section it is any currency. You have to be very careful with that. Plus here the tax rate is just 5%. TDS will be deducted under a special section 194 LB. Who will deduct TDS? Payer will deduct TDS. Who is payer? Infrastructure debt fund is payer. Infrastructure debt fund will deduct TDS at the rate of 5%. Okay. Then rest of the things are same as the first section only. Okay. Everything is same as the first section. So you can just copy paste that. The third section is the most critical one. There are a lot of nitty-gritties in the third section. In the third section also the assessee is non-resident and foreign company only. The assessee is not changing. The payer is changing. Now the payer is only Indian company, not Indian concern, not government, but only Indian company. Now what the non-resident and foreign company is doing? Non-resident and foreign company is giving loan to you. To whom? To Indian company. They are buying long-term bonds. Whose long-term bonds? Indian companies long-term bonds they are buying. Okay. And in which currency they are buying? They are buying in foreign currency. Very important aspect. They are buying in foreign currency. The bonds are issued in foreign currency, loans are purchased, loans are borrowed in foreign currency, and it is borrowed between this period. There is a period for borrowal. It is borrowed on or after 1st July 2012 till 30th June 2023. Then the tax rate is just 5% and the TDS will be deducted under 194 LC. How much percent? The tax rate is only 5%. Now, there is one more instrument which is over here. Apart from loans and long-term bonds, there is rupee denominated bonds which is covered over here, and that should be in any currency, need not be in foreign currency. It can be foreign currency, it can be Indian currency, and that is also should be issued till 30th June. Here the tax rate is 5%. Now here there is a catch. In case of some rupee denominated bonds, interest is exempt. Which are those lucky rupee denominated bonds? Let's come to the note. If the rupee denominated bonds are issued between 17 September 2018 to 31st March 2019, which date? You have to be very careful. ICI is playing with this data in the examination. If the rupee denominated bonds are issued between 17 September 2019 to 31st March, 17 September 2018 to 31st March 2019, then under 194 LC, such interest will not be chargeable to tax. Okay. Apart from that, it will be chargeable at 5%. I hope it is clear to all of you. Now, in some special cases, the tax rate will be only 4% and in some cases it is 9%. Listen carefully when it is 4% and when it is 9%. When a non-resident buys a long-term bond or a rupee denominated bond of Indian company which is listed in a recognized stock exchange in IFSC. So the long-term bonds and the rupee denominated bonds, if it is listed in a recognized stock exchange in IFSC and if it is purchased between, if it is issued between 1/4/2020 to 30th June 2023, then it is 4%, and if it is issued after 30th June 2023, that is from 1st July 2023, then it is 9%. You have to be very careful with that. So this IFSC wala point between 2020 to 2023 June, it is 4%, and after 30th June 2023, it will become 9%. Plus, rate has to be approved by central government. In the first two sections, the interest rate will not be decided by the government of India. But in the third section, the interest rate will also be decided by the government of India. You have to be very careful with that. So there are multiple tax rates over here. 5% normally. Okay. Rupee denominated bonds also 5%. But if the rupee denominated bonds and long-term bonds are purchased through a recognized stock exchange in IFSC and it is till 30th June 2023, then 4%. After 30th June 2023, then it is going to be how much? It is going to be 9%. Rest all is same as the first section. Okay. Now coming to the fourth section. When I come to the fourth section, I have to be very careful with that. I should close my eyes and think. Who was the assessee in the first section? It was non-resident foreign company. Second section, non-resident foreign company. Third section, non-resident foreign company. But in the fourth section, it is not non-resident foreign company. It is FII and QFIs. So in the fourth section, it is FIIs, foreign institutional investors or qualified financial investors. These are the assessees. What are they doing? They are buying rupee denominated bond. They are buying government securities. Okay. Of whom? They are buying rupee denominated bond of Indian company, government securities of government of India. So they are buying two things, rupee denominated bonds of Indian company and government securities of government company. In which currency? Any currency. And here the interest has to be payable between 2013 June to 2023 June. Here the interest has to be payable between this period. In this section, it was not interest. It was in the third section. It was the money should have been borrowed between this period. But here the interest should be payable between this period. Then it is covered over here. Apart from this, one more item is covered. Apart from government security and rupee denominated bond, municipal debt securities are also covered if the interest is payable between 2020 to 2023 June. So there are in all three securities mentioned over here: government security, rupee denominated bond, and municipal debt security. For municipal debt security, the time period is shorter, from 2020 to 2023. Here also the rate of interest will be approved by the central government. Rest all is same as the previous three section. The section of TDS changes everywhere. In the first section it is 195. In the next three section it is 190 for LB, LC, and LD in the order, alphabetical order. I hope it is clear with you. This is how you are going to remember the things. You have to close your eyes and then now you have to think. In first section, the pair is non-resident foreign company. Second also same, third also same, but fourth one changes. It is FII QFI. In first section, it is Indian concern and government. In second, it is infrastructure debt fund. In third, it is only Indian company. In fourth, it is government and Indian company. This is how you are going to remember the things. You do it 2-3 times, you will be remembering. Don't worry. Don't leave all these things. These are very important things for the examination. Okay. So don't leave all these things. Now, coming to royalty and FTS. Now remember, for royalty and FTS, there are three possibilities. Always remember, if there is a royalty and FTS, and if there is no PE, there is no PE of the non-resident and foreign company, but there has to be an agreement between both the party and it should be approved by central government. If there is an agreement and it is approved by central government, then it can come either in 115A or 44DA. For coming under 115A and 44DA, there has to be an agreement between both the party and it should be approved by central government. Otherwise, you will not get the advantage of these two sections. If there is no agreement, or if there is an agreement which is not approved by central government, then you don't come to 115A and 44DA. Then normal provision will apply, and normal provision means normal tax rates, etc. You can claim deductions also, all those things. Special tax rates will not apply to you. Okay. Now 115A, when 115A is applicable, when there is no PE, and when 44DA is applicable, when the non-resident and foreign company has a permanent establishment in India and provides services, okay, in the nature of royalty and FTS. Let's talk about 115A first. In 115A, non-resident and foreign company is providing some services for royalty and FTS to Indian concern and Indian government. Obviously, there has to be an agreement which is approved by central government. Unless until these words are written in the examination, you cannot come under 115A. Plus, there is no permanent establishment in India. There is no permanent establishment in India. If there is a permanent establishment, you will go to 44DA. But even in 44DA, there has to be an agreement which is approved by central government. Agreement and approval is must under both the sections. Okay. Now, let's talk about 115A first. In 115A, the tax rate is changed by Finance Act 2023. Earlier, it was 10% or DTAA, whichever is lower. Now, it is 15, 20% or DTAA, whichever is lower, and TDS will be deducted under 195. Okay. TDS will be deducted under 195. What about PGPP expenses? You are not going to get any PGPP expense, but fortunately, against this income, you can claim Chapter 6A. Chapter 6A, all Chapter 6A are allowed against this income. Don't worry about it, okay? Set-off of loss also allowed. Rest of the things are same as the first section, okay? Rest of the things are same as the first section. For ITR also, you have to follow the same things. If you have only earned this income, and the TDS is deducted at 20%, not lower than 20%, then there is no need to file ITR. Okay. Now coming to 44DA. 44DA is applicable when the non-resident or foreign company has entered into an agreement with the Indian concern or government and it is approved by the central government. Okay. And they are providing some services and FTS, royalty, and the non-resident has a P in India. Then what will be the tax rate? Then the tax rate will be the normal rates. For foreign company, it is 40%. For others, whatever is the normal rates, that will be applicable. TDS will be deducted under section 195. Whether the expenses of PGPP expense will be allowed or not to assessee. Yes, all PGPP expenses will be allowed to the assessee, but some of them will not be allowed. Like. If an expense is not wholly and exclusively for Indian branch, then it is not allowed. If an expense is incurred partly for Indian branch and partly for HO, then it will not be allowed. Similarly, if I have taken some services from my HO and I am making some payment to my HO, then that is also not allowed. But if I am making some reimbursement to my HO, then that is allowed. Be very careful. If I am taking some services from my HO, I am making the payment to them, it is not allowed. I have told you logic, all of the logic I have already told you in the class. Whether you have taken my regular or fast track batch, I have already told you the logic behind all those things. Okay? Because it is a payment to self. Okay, if you make a payment to self, then it is not allowed a deduction. But if you are making a reimbursement to your HO or to any other branch, then it is allowed as a deduction. Okay, this is what it is written over here. I hope it is clear to all of you. Now coming back to the discussion, what about Chapter 6A? Yes, Chapter 6A is allowed in 115A also and in 44DA also. Against your royalty and FTS income, you can claim that. Okay, now other normal rates will be applicable here for other income. Chapter 6A will be allowed for other income also, and in this 44DA, you have to file ROI, you have to maintain books of account, you have to conduct tax audit. First proviso, second proviso is not applicable here. It will be applicable from the 7th and 8th sections onwards. Right now, it is not applicable. It is not relevant in this particular section as of now, at least. Now, few important points that I would like to further say over here before I go ahead. Sir, what about dividend incomes? Now remember, dividend incomes are also taxable under 115A only. If a non-resident or foreign company is earning some dividend, it is taxable at 20%. Okay, plus surcharge if applicable and cess. But there is a Finance Act 2023 amendment which says that if a non-resident or foreign company has invested in a unit of IFSC, and if they receive dividend from unit of IFSC, then the dividend will be taxable at only 10% only, not 20%. So if the non-resident or foreign company has invested in the units of IFSC, and from there if they are getting some dividend, that will be taxable at 10% instead of 20%. Okay, one more thing, one very good exemption given for interest. Suppose if there is a non-resident outside India which is giving loan to a unit of IFSC, and unit of IFSC is paying interest to them, and the loan is given on or after 1st September 2019. So if the non-resident or foreign company is giving loan on or after 1st September 2019 to an IFSC unit, and in return they are earning some interest, then that interest is fully exempt under section 1015. Forget about 20%, 5%, 4%, 9%. It is fully exempt under income tax law. There is no tax which will be chargeable on that particular interest. I hope it is clear to all of you. Next, further important points. Now, whether MAT will be applicable on these interest and royalty income, sir. Remember, the MAT will not be applicable if your normal tax rate is lower than the MAT rate. Suppose if your normal tax rate is less than the MAT rate, what is the MAT rate? 15%. If the normal tax rate is lower than the MAT rate, that is lower than 15%, then MAT will not apply on those incomes. So wherever the interest is chargeable at less than 15%, MAT will not apply. Wherever the royalty and FTS, if chargeable at less than 15% because of DTAA, it might be chargeable at less than 15%, then MAT will not apply. But if the royalty and FTS or interest is normally chargeable at more than 15%, then MAT will apply. This is a very important point. My gut feeling says that they might ask you some question based on this. Okay. Last but not least, just an information. Chapter 6 say if you are getting as a deduction, that is only possible if you follow old regime, because in new regime, most of the chapter 6 deductions are not allowed, except 2-3 deductions which are allowed. Most of the chapter 6 deductions are not allowed under the new regime. Now, coming to the 7th section. What is the 7th section? Who is the assessee in the 7th section? The assessee in the 7th section is Overseas Financial Organization. What is it? What is the assessee doing? Now the assessee is investing in units of UTI mutual fund in foreign currency. What is the assessee doing? Assessee is buying the units of UTI units they are buying, or they are buying mutual fund units, and that too in which currency? In foreign currency. Okay. Now rates of tax. How much tax will be charged? Long-term capital gains will be charged at how much rate? It will be chargeable at 10% only. And what about short-term capital gains? Short-term capital gains will be chargeable at normal rates. Okay. For short-term capital gains, there is no separate section given over here. This section only talks about what? Only talks about long-term capital gains. Okay. Now, what about the deductions? Will I get any deductions of PGBP? How the hell you can get a deduction of PGBP against capital gains income? That is not possible only. Will I get deduction of chapter 6A? No, chapter 6A will be allowed against this LTCG. Anyways, against LTCG, chapter 6A is never available. Okay. You might be knowing, again, LTCG, chapter 6A never available. Against 111A, chapter 6A never available. Against casual incomes also, chapter 6A is never available. So here also chapter 6A will not be available. Loss, if there is some other loss, long-term capital loss, short-term capital loss, that you can set off against this particular capital gains. Other income will be charged at normal rate. ROI you have to always file. Even if you only earn this income now, then also ROI is supposed to be always filed. And whether first proviso and second proviso to 48 is applicable. First of all, sir, tell us what is first proviso and second proviso to 48. First proviso to 48 talks about TTBR, TTSR, all those things. Do you remember that? So here, no first proviso to 48 will be applicable. You are not supposed to convert into dollar and then reconvert into rupees. All those things you are not supposed to do. And second proviso is about indexation. Here, indexation is also not available, not available, not available. Be very careful. Okay. Now coming to the next section, which is important one, and this is the section where many students get confused with the third category of interest. I'll tell you which category of interest I'm talking about. 115AC, there is a non-resident or foreign company. What is that non-resident and foreign company doing? It is buying bonds of Indian company in foreign currency. It is buying bonds of public sector companies sold by government in foreign currency. It is buying bonds of GDR. It is buying GDR in foreign currency, and all of them should be notified by central government. Now, a lot of students have doubt that, sir, if a non-resident and foreign company is buying bonds of Indian company, so here also it is written bonds of Indian company in foreign currency, and in 115A, third section also it is written bonds of long-term bonds of Indian company in foreign currency. So which one to follow, sir? So remember, in the exam, if it is written in the question that it is notified by central government, then you should follow 115AC, and if it is not written that it is notified by central government, then you can follow the third interest of 115A. Okay, but if it is written notified by central government, then Indian company bonds will cover under 115AC. I hope it is clear to all of you. So Indian company bonds purchase in foreign currency, public sector company bonds purchase in foreign currency, and even GDR purchase is in foreign currency, all of them should be notified by central government. Okay. Here, the interest income, whatever interest will come on bonds will be taxable at flat 10% and LTCG will be taxable at 10%. What about STCG? STCG will be taxable at normal rate. Now, everything is same except this part which is different. Here you are getting relaxation, no need to file ROI if you earn only interest income and TDS is deducted. If you earn only interest income and your TDS is deducted, there is no need to file ROI. Okay. Now, the the ninth section is again a very important section which covers FII and specified fund. Now, FII is also repeating twice. It is coming here and it was also there in the fourth section. So, which one to follow, sir? So, which one to follow? So, if FII is buying these items, then you have to follow 194 LD only. First preference will be given to 194 LD. If your case is not covered in 194 LD, then you will come in 115 AD. But in 115 AD, there is one more person. That is specified fund. There are two people over here. What are these people buying? FIIs and specified funds are buying any kind of securities in any kind of currency. No foreign currency is required other than 115 AB. Apart from this, units of UTI and units of mutual fund, they might buy anything. And whatever they buy, whatever they sell, on that, if there is a long-term capital gains, normal long-term capital gains will be charged at 10%, normal short-term capital gains will be charged at 30%, and 111A and 112A will be charged the way it is charged, 15% and 10% subject to 1 lakh exemption. Further, the interest and the dividend will be chargeable at, for FII, interest is chargeable at 20%, for specified fund it is further lower, it is only 10%. And if 194 LD is covered over here, if the non-resident and if the FII is buying the say rupee denominated bonds of Indian company or buying government securities or municipal debt security, then 194 LD will apply and 5% tax will be applicable as per 194 LD only. Okay, I hope it is clear. One more important point, this section is applicable, this relaxation is applicable only to the extent the units are held by non-resident. Suppose the specified fund has 100 unit holders, out of which 70 unit holders are non-resident, then only 70% of the income will be subject to this relaxed rate. Remaining 30% of income will be subject to normal tax rate. So if the FII or QFI wants to, FII or specified fund wants to make their entire income covered under this, then all the unit holders have to be non-resident. Okay, otherwise they will not get the relaxation on the entire income. One last thing, the entire rest of the all things are same as the first section only. Okay, now one last section over here which is very important, which is chapter 12A 115C2I, which is applicable to non-resident Indians only. Okay, not applicable to everyone. Who are non-resident Indian? It is non-resident as per income tax law, plus they are either citizen or person of Indian origin. They have to be either citizen or person of Indian origin, then they are called as non-resident Indians. Okay, so this chapter is an optional chapter for them. If they want to opt it, they can opt. If they don't want to opt, they may not opt. It is their choice. Okay, now non-resident Indians, what are they supposed to buy? They are supposed to buy certain specified assets in foreign currency. They are supposed to mandatorily buy in foreign currency. Indian currency is not covered over here. What is covered? There are 4 assets which are covered. Indian company shares, private or public, both the companies are covered. But debentures have to be only of public company and deposits also only public company. Debentures and deposits of private company are not covered over here. Then government security is covered. Only shares of Indian company, private, public, both are covered. Now, if the non-resident Indian buys these assets in foreign currency, then interest will be taxable at 20% and long-term capital gains will be taxed at 10%. Remember, wherever it is written, long-term will be taxable at 10%, 10% and 10%, except the third one, not this one. The first, second and this fourth one, everywhere, whether it is a stock market long-term capital gains or a normal long-term capital gains, everything will be taxed at 10%. In these 3 sections, 112A, 112A and 112A will not apply. In the third section, it will apply because it is specifically mentioned 112A. But in the first, second and fourth section, 112A is nowhere mentioned. So all kind of long-term capital gains will be taxable at 10% in these 3 sections. I hope it is clear to all of you. Now, one of the biggest advantage of coming to this section is, that is the chapter, this chapter is optional, 115C2I, chapter 12A. One of the biggest advantage of coming over here is that you get an exemption under 115F. What is exemption under 115F? So if there is a long-term capital gains, and if you want to exempt that long-term capital gains, so within 6 months of the date of transfer, you have to reinvest in the specified assets. If you reinvest the net consideration in the specified asset, then your capital gains will be exempt. If you invest lesser than net consideration, then proportionate capital gains will be exempt, just like 54F. Okay, if you want to gain, if you want to exempt entire capital gains, then entire net consideration has to be invested. Okay, otherwise you will not get full exemption, you will get proportionate exemption. Last but not least, will you get any PGBP deductions? No PGBP deductions, no chapter 6 deductions, set off of loss can be claimed. ROI, need not file ROI. If you earn only these incomes and TDS is deducted, there is no need to file ROI. One very important difference as compared to the previous section, your first provision to 48 is applicable. It means if in the question they have given you the details of TTBR, TTSR, because they are buying in foreign currency, right? If they are given you the details of TTBR, DTSR, then you have to convert that into dollar, then reconvert that into rupees as per rule 115A. Okay. And last but not least, second proviso 248 not applicable. It means indexation will not be applicable in this case. So this is how you are going to revise the 10 sections. Believe me, student gives hours and hours to do this section, still they don't get comfort in this section. This is the only way in which you can revise this particular thing. Okay, so that's it from my side. Whatever I could do from my side, I will be continue doing for my South Indian students along with my North Indian students. Don't worry about it. But ultimately, I am also a human being. I may fall short of few things at the end of the day. I'm trying my best. I'm working for around 10 to 12 hours every day, minimum. In that, I'm taking lectures. I'm taking my old batches also, some live batches also going on. That also I'm doing. But I'm putting special attention to your attempt of May 2024. So at the end, I might skip few of the things. So please forgive me for that. I may not be able to cover all of them, but whatever I have covered, that is much more than anybody would have covered ever in the entire country for you all in direct tax in English. That is my guarantee. Okay. So be self-satisfied in life and don't be unsatisfied in life. Take care, all of you. Bye. See you soon.